probably the fastest I'm talking about the parent bank in the US to start with, actually. The fastest passage from sort of health to death, really since Barings, actually, I'd say. I mean, Barings, as you'll remember, was a sort of Friday to Sunday thing, and this was pretty similar. So, yes, I mean, I would, if you don't mind, draw a distinction with Credit Suisse, which we might come on to, which is actually a much more drawn-out affair. But, yes, it was a very fast passage to failure.
So you mentioned Credit Suisse, their governor, and obviously quite a few of banking stocks, regional banks in the US. We've heard in recent days pressure on the share price of Deutsche Bank and so on. You probably won't want to comment on areas outside the UK, but I just wondered whether you think today that these individual idiosyncratic events are now past and that things have settled down and this turmoil in the banking sector in March is behind us?
Well, we've sent you an assessment of the UK banking sector, and obviously we'd be very happy to discuss any points you want to discuss out of that. I think the US authorities are still dealing with some of the consequences of the issue in the regional banks that manifested itself in Silicon Valley Bank. I think Credit Suisse, I would say, well, obviously, as you say, come on to, happy to talk about that, is a rather institutional specific story about long-run issues in the institution. So my view, and my very strong view with the UK banking system, is that it is in a strong position, both capital and liquidity-wise. It is not showing signs of problems in that respect, and we tested, as you know, very extensively. I also think that what we saw at the tail end of last week, Friday in particular, when there were quite sharp market movements. I think there are moves in markets to, if you like, test out firms. I would not want to say that those, in my estimation, are based on identified weaknesses more than testing out. I mean, there is quite a bit of testing out going on at the moment, I think.
And last September, obviously, there was the stress test of the liability-driven investing, which was way outside the parameters of any stress test that you had run. Sam, have any of these developments been outside the stress tests of the sorts of things that you model for?
Well, I'd make a distinction here between the capital treatment of interest rate risk, which was a relevant factor in the demise of the parent bank, Silicon Valley. We do capitalise that risk very thoroughly for UK banks, including, by the way, for Silicon Valley Bank UK. I'm entirely content that the stresses we've seen are inside the types of stresses that we apply for capital purposes. Where I think there might be more of a policy question, it's an international question in which we'll take a close interest, is around the calibration of the liquidity coverage ratio. So that's the sort of 1 month liquidity, if you like, the banks have to hold. And as Andrew was just mentioning, a very striking feature of the Silicon Valley Bank run, not so much of the Credit Suisse one, by the way, was just the speed with which it took place. And I think there's a table in Andrew's letter, quite helpful. What you can see is basically 3 billion in deposits, or 2.9, going out in a day on Friday the 9th of March. The sort of outflow rates that we have, so the percentage of deposits that are assumed to run out in that LCR ratio, some actually are 100%. So deposits from financial institutions are assumed all to go, but operational deposits are less than that, and retail deposits less still. So I think there's going to be a question for all of us as to whether, but it is a question, I emphasise, whether those outflow rates are quite high enough.
Well, I think it's much easier now, isn't it, to move your deposits electronically. You don't have to queue round the block to take your money out of a particular bank. You can move it within seconds. And so presumably you will have to think about what it is that you stress test for when you're looking at some of these rules.
Yeah, I think that's right. I mean, all of us could move money from our accounts in a shorter time than it's taken me to answer this question, as you say. And that is a relatively new feature of the market. The other aspect that we've had, and we have dealt with, by the way, in various situations in the past, but it's more prominent, is the speed with which news can travel, particularly among communities and sometimes sort of through private messaging groups. That is a noticeable phenomenon both here and elsewhere. I do think that in this case you also had an issue that you asked about in your letter, which was the concentrated nature of the deposit base of this particular firm. I think that was an exacerbating factor, but we're going to have to look at all of that for sure.
Just one moment, Dave. Governor, in terms of the events of March, I'm not sure that I heard a clear sort of yes/no answer to my question about were these some pressures at idiosyncratic cases around the world? Is this something more systemic? And would you be able to say today, as we near the end of March, that this turmoil is behind us?
Well, I think there is a story in the Silicon Valley Bank US case, which I think we will come on to, I'm sure, which is to do with the treatment of what we call interest rate risk in the banking book. So this is not trading activity, this is interest rate risk in the bank. We treat that differently in our capital regime, which I think we set out in the paper we sent you, and I'm happy to, we'd be happy to go through that. We treat it differently to the US, and that is an important difference. So I think there is an issue there, because of course that obviously goes back to, sorry?
We're not out of the woods. The banking sector is not out of the woods.
That is an issue, but it's not, I think, an issue in the UK because we do treat it differently, and that obviously relates to the question of the, of the rise in interest rates and how much and how quickly. I think there's a lot that was there was a lot that was idiosyncratic about Credit Suisse, which we can say a bit about, but obviously it's not one of ours as a parent. Now, to your question, I don't think that any of them, and we've said this, that any of these features cause stress in the UK banking system. But the definitive yes/no answer to your question goes back to what you said about the markets last week. They are trying on to find points of weakness at the moment. Now, I don't think we are at all in the place we were in 2007-8. We're in a very different place to then. But we have to be very vigilant. So if I give you the answer, I don't think there's a problem going forwards. I do not want to give you for a moment the idea that we are not very vigilant, because we are. We are in a period of very heightened, frankly, tension and alertness, and we will go on being vigilant. So, in a way, that's the message I'd really like to give you, if you don't mind, in answering that question.
Okay, thank you. Dave, you wanted to make a point.
Thanks, Chair. All I wanted to really do was illustrate the point Andrew was making about the wider context. I mean, when you think of what's going on in global financial markets at the moment, I mean, the US Treasury market, one of the most liquid in the world, implied volatility last week close to post-global financial crisis highs. So you've got the recent events in these particular banks that have, the markets have responded to, and as Andrew says, are testing. But that also plays into a longer term picture. We've all appeared before you to talk about the LDI episode last autumn, where you've seen these events, off the scale, moves in markets triggering responses. So I think this is why we have to remain incredibly vigilant, looking for...
Good morning, it's 10 o'clock. You're watching Sky News and this is Ian King Live, an hour of business and economic news from the heart of the city. Well, before we get to our guests this morning, we're currently listening in to the Treasury Select Committee, where the Governor of the Bank of England, Andrew Bailey, is giving evidence to MPs over the collapse and rescue of Silicon Valley Bank. We'll have a listen to this.
Other risk factors, but we have to remain incredibly vigilant.
I would just note that in terms of the government bond markets, you mentioned US Treasuries, two of the big buyers, which were the Federal Reserve Bank and China, probably not buying as much as before. And so I do accept that you'll need to be vigilant on those risks. Anthony.
Thank you, Chair. So my questions are really going to focus on whether Silicon Valley Bank was prepared or not, or how well prepared. So on Thursday, the 9th of March, I think I'm right in saying that if your assessment of Silicon Valley Bank would be that it met all the regulatory requirements.
What about UK?
Yeah, UK, Silicon Valley Bank UK. It met all the regulatory requirements you'd expected of it. It was well capitalised. It had the right liquidity coverage ratio. It was closely supervised by you. You had the information you needed about it, and yet it collapsed the following day. Doesn't that suggest that your supervisory regime and criteria simply aren't fit for purpose?
Well, let me start. I'm sure some will probably want to come in. Key point I'll make two key points to you to start with. No subsidiary can be expected to survive the failure of its parent. I don't think that is a reasonable expectation. I mean, they're too tightly associated and connected to do that. So, but I'm going to make another point.
It's not always true. I mean, some subsidiaries would. But anyway,
I think it's unusual. Put it that. I would not expect. I would not work on the basis of that expectation. Now, by the way, one of the key things that was done, and it was done last summer, it took about 2 years to do, was that Silicon Valley Bank UK was a branch until then. Now, it passed through the point in our policy where there's a level of FSCS protected deposits, and if a foreign branch goes above that level, then we say you need to subsidiarise, and it did that. And I want to stress that because had it not done that, had we still had a branch on our hands, it would have been an altogether much more difficult situation. So that's important. It was subsidiarised. The point I want to make, you said, I said in response to you, well, no subsidiary will survive the failure of its parent, but that's not the end of the story, because what we had, I think, on our hands was a well-capitalised subsidiary, and it had strong liquidity. As Sam's just said it, it lost about 30% of its deposits in one day, but it did have the cash buffers to meet those outflows. Now, that's important because what it meant is that going into the weekend, we were working with a bank that there was a reasonable prospect that we could do something to resolve it, which would come out on the other side as it did with a purchase. Frankly, if the bank's not solvent going into the weekend, that becomes immeasurably harder. So I would emphasise, I don't think you can expect we should not work on the assumption that subsidiaries will survive the failure of their parents. But what we must do is have the subsidiary in a good state, so that when we then turn to resolution, we can do something with it.
So briefly, I think the team did a very good job of making sure that the UK subsidiary was capitalised, including on concentration risk and on interest rate risk. But back to your original question, there is a bit of a trade-off in these things. We could remove run risk from banks by requiring 100% outflow of all deposits to be held in reserves at the Bank of England. But we're choosing not to do that. We do not want to operate a zero failure regime because there would be some significant costs in terms of availability of lending to the economy. And that's a trade-off that is made in all regulations. Having said that, I won't repeat what I said earlier, but I do think we've got to look back at these outflow rates in the LCR specifically and say, what have we learned from this? Also, in due course, what have they learned from the other banks in the States that we're not involved with?
So is it as far as you're concerned?
That was Sam Woods there speaking, the head of the Prudential Regulation Authority. If you want to continue following the Treasury Select Committee, you can scan the QR code, which is about to come up on the side of your screen right now.
Need to know to be confident that it really was healthy.